and you are at age 70 and a half, this is the normal IRS rule for making a qualified charitable distribution. And what it is, from your IRA, rather than taking a distribution into your checking account, that would be a cash distribution, and then writing that check to the recipient organization for it, you now bypass that. So what you do is you make a contribution, and it can be up to $100,000 directly to the recipient organization. And I'm going to speak with Groundswell as the example for the recipient of that charitable distribution. Now, when I say that the limit is $100,000, that is in aggregate. So if you have a couple of IRAs, you are limited to a total of $100,000. What is different as a result of the CARES Act, and as far as we know, it is just for 2020, there is a way to make a qualified charitable distribution like contribution out of your IRA. It works a little bit differently if you are under age 70 and a half. And the reason it's age 59 and a half and not younger than that is, as you probably know, if you take a distribution from an IRA before you reach age 59 and a half, there is a 10% early withdrawal penalty. So I'm going to continue talking about right now if you're in that age 70 and a half demographic. One of the other...
Sorry to interrupt. So we did also get one question, is if the $100,000 limit is per individual donor?
Yes. Yes.
Good.
So age 70 and a half, prior to the CARES Act and the Secure Act, was when an individual would be required to start taking a minimum distribution from an IRA and from any other kind of retirement plan, like a 403B, a 457, a 401k account. That has now been changed to age 72. However, qualified charitable distributions are still allowed to be made if you are age 70 and a half. And what's different with 2020 is the way you can simulate making a qualified charitable distribution just for this year. What's unique about the qualified charitable distribution is it counts towards that required minimum distribution up to $100,000, and it's not taxable income, meaning you don't include the amount of that qualified charitable distribution on your tax return. You also, on the other hand, do not get to double dip by claiming it as a charitable deduction when you're going through, if you itemize and claim it as a deduction in that regard. Let me go back to that slide then and explain. So this year, and this year only as far as we know, the aggregate, the adjusted gross income, AGI, on your taxes, there have been limits which have normally been for cash gifts up to 60%, and that's for non-itemizers. And that has been waived this year for all types of cash gifts, no matter what type of gift it is. So the limit is 100% of your AGI. So as an example, if an individual is over 59 and a half, they've turned 59 and a half, so they are over 59 and a half, and they want to make a charitable contribution, let's say their AGI is $150,000 a year. They could take a distribution from their IRA for $100,000, then make a cash contribution for $100,000 to Groundswell, And because the limit is up to either $100,000 or 100% of your AGI, the full $100,000 cash gift made to Groundswell then would be a charitable deduction. It wouldn't be subject to the 60% limit on a cash gift. So again, the way you can't make a true qualified charitable distribution where the contribution is made directly to Groundswell as my example charity. For if you are under age 70 and a half, what you do is you take the distribution yourself out of your IRA. I'm going to go back here to this. So if you're under age 70 and a half, you take the distribution from your IRA, goes into checking, and then you write the check and make a cash gift to your charitable organization, Groundswell in this instance. Yes, you have to include that on your tax return, but you get the full deduction because for 2020, the limit of 60% of adjusted gross income has been changed to 100%.
And so Jeannie, someone just asked that, is it correct that there is no required minimum distribution for 2020?
That is correct. So if you are age 72 and would have had to take a required minimum distribution, and this is true if you had already started taking required minimum distributions prior to this, let's say you're 73, so or even you're 71 this year and you started taking your required minimum distributions already, you do not have to take those this year. Now, if you're in a fortunate situation where you really don't need that income and that having to take that required minimum distribution has been something you would rather avoid, it's a great opportunity to gift it as a qualified charitable distribution. So let's say you would have had to have taken a $50,000 required minimum distribution this year. You don't have to take it, but if you don't need the income, one of the great opportunities is you can still make a qualified charitable distribution. So again, going back to this example, what would have been the amount you would have had to have taken and be taxed on as a required minimum distribution, you can still make that qualified charitable distribution by directly giving it to the charity or your church. Now, qualified charitable distributions, in normal years, when they are satisfying your required minimum distribution, you cannot give those to a donor advised fund. And that's just one of the IRS rules. Excuse me. So again, you do not have to take your required minimum distribution this year. You can take it. I mean, I work with clients who that is part of their retirement income plan. So they would take it regardless. However, if you don't need it and you want to avoid having, and you would in normal years have to take it as taxable income, you can now gift that amount. Now, another opportunity that a lot of people may not be aware of or don't consider is when you're making, or if part of your normal gifting strategy is to every year make charitable gifts, an opportunity to benefit both your recipient organization and have some tax advantages is to instead gift a security. I'm going to use a stock as an example because most of us are very familiar with stocks. You would gift a stock in your portfolio that has appreciated. So it, and by that, I mean, I'm going to use AT&T as a stock as an example. It's AT&T is a mature company. It's not a growth type of stock where you're expecting to have the value, the market value of that stock really going up anymore. So you could gift that directly, and this is something that our firm does with clients. We can help do that. You can gift it either directly to the charity, or you can gift it to a donor advised fund. Donor advised funds can typically accept many different kinds of securities in addition to cash, but it's an advantage to you because you won't have to pay capital gains tax anymore on that security when it's sold, and you get the full tax benefit of it, and the recipient organization receives that, and they would not be subject to any capital gains tax. So for example, if I have AT&T in my investment portfolio, in my investment account, and I would like to make a contribution that might be larger than what I would give as cash, I could contact Groundswell. I could speak with Heidi and say, Heidi, I have $50,000 in AT&T. You know, I would like to gift that to Groundswell. How do I do that? And then, you know,
and I would say that we have a Charles Schwab account, and we would provide you with the information for placing that gift, that stock, appreciated stock, in the Charles Schwab account, which is managed by SVA for us. SVA would then sell the stock for us and put that money then into our account.
Mm-hmm.
Jeannie, do you want to, I think you have a slide actually where you show that, or no, maybe that is showing that it's going not from the brokerage account to checking, but actually directly to the charity.
Right.
Right.
So here's that slide. So rather than selling that stock yourself, taking the cash, because then you would pay capital gains on it. You know, let's say you have $50,000 of AT&T, you bought it at $5,000 a share. So you now would be paying capital gains tax on $45,000 worth of capital gains. So you pay the capital gains tax, but then you still want to give $50,000. So you write a check for $50,000 to the charitable, to Groundswell. You do get the tax deduction for it, but in normal years, it would be better if you gift the stock, the AT&T stock, directly to Groundswell. That way, I'm not having to pay any capital gains tax on that. And in normal years, this year I'd still be able to take the full deduction, but I would have paid capital gains tax. So there are at least two tax benefits to making a direct gift of a non-cash security.
Jeannie, we did also get one question going back to the IRA before we move on to the donor advised fund. This person is saying that I am thinking about holding some of my planned 2020 gifts to early 2021 so that I can count the tax exempt gift towards RMD in 2021. Is that a good strategy?
If they take RMDs anyway, yes. Then I would say the only change from the CARES Act in this case would be that you don't have to take the required minimum distribution this year. So if you leave it in your IRA and then next year you intend to give it, however, depending on what the amount was and what the amount of your required minimum distribution would be, remember, you're limited to $100,000. So you can't bunch it up if you were going to give $100,000, you know, have a $100,000 RMD this year, and then next year it'll probably be even a little higher because the RMD, the required minimum distribution amount, goes up a little bit each year. There's actually a table that the IRS has that is used. It's a factor that's multiplied against, you know, the balance in your account as year end. That factor is based on your age, and that's what results in your required minimum distribution. So yes, you could bunch them. Just remember that every year, and this hasn't changed with the CARES Act, you are limited to $100,000. Did that answer your question? I'll assume yes.
Yeah.
Okay. So getting back to the donor advised fund. So a donor advised fund is, I'm going to use Schwab Charitable as an example. A donor advised fund is a nonprofit organization. What they do is they can accept cash, publicly traded securities like stocks and bonds. They can also often accept real estate, real property. They can accept illiquid types of assets. Each donor advised fund has its own rules and limitations on what it will accept, but most of them that I've seen are very, very broad. So for example, if you had property that you had been, you know, have in a real estate portfolio, and you are now looking at your estate planning and you feel that you no longer need this piece of land, well, you could sell it and then take the cash and donate the cash directly, or you could gift the land to a donor advised fund like Schwab Charitable, and you will get the tax deduction for the fair market value of the land. The donor advised fund will sell the land at the fair market value, and then they invest it. So you can set up a donor advised fund and you can always add to it. Another one of the great advantages of a donor advised fund is you have up to 5 years before you actually have to make a request to give a gift. So for example, let's say our property owner, they decide to make a charitable gift of real property, of land, to Schwab Charitable. They get the fair market value deduction. It takes it out of their estate, and you get that tax deduction in the year that you give it. And those gifts, by the way, need to be made by December 31st of the year you're going to do it. It's not like other kinds of contributions you can make, like to an IRA, a traditional IRA, a Roth IRA, where you have until the tax filing deadline of the following year. Charitable gifts, whether it's cash or an asset, needs to be made by year end of the year that you want to take the tax deduction. You don't get to each year then make a grant request, is what it's called. Say you put $100,000 worth of land into your donor advised fund. 2 years later, you make a $20,000 gift. You tell Schwab Charitable, I'd like $20,000 gift to go to Groundswell. You don't get to take a $20,000 charitable gift deduction 2 years later. You get that $100,000 deduction, let's say it's in 2020. In 2022, then, when the request is made and Groundswell receives the gift, you don't get to take another deduction. An advantage also to think about is if you have a legacy of charitable giving and you would like to pass that on to your family, you can actually set it up and name who will be successor grantors in the future. So, you know, if you want to create, I'm going to use the John and Jane Doe giving, legacy giving account. Let's say they have 3 children. They can name the 3 children as who can make grant recommendations after both John and Jane Doe have passed away. You can make grant requests to any qualified charity. And if you're not sure if the organization you would like to make a grant request to is qualified, Schwab Charitable, in this example, would be able to check that for you. There are other websites that you can go to, but it would be best to just ask the donor advised fund directly. I mean, there are thousands of qualified charitable organizations. So especially in Dane County, I would be surprised if just about any organization or church that you wanted to make a gift to would not be considered a qualified charity.
Jeannie, so we're getting close to time and we have several questions.
Sure.
Are we able?
This is basically the end.
Okay.
Here.
Okay.
I'll just leave this up here so
Okay.
that, you know, obviously the audience should know you, Heidi.
Mm-hmm.
If you don't, Heidi is incredibly helpful with answering questions. I'm sure she would be very, very happy to talk to you if you were thinking of making gifts to Groundswell. And then here is my contact information, both my phone number and email address if you have any follow-up questions that we can't address today or would just like to talk with me more about today's presentation.
Great. So the person who was asking those questions before about the RMD has another one saying, isn't the limit 100,000 or your RMD, whichever is less? In other words, I can't make a QMD for 80,000 if my RMD is only 65, correct?
You can actually make up to $100,000, the RMD being satisfied. I mean, if you wanted to make a second distribution, you could. As far as satisfying the RMD, you know, if your RMD is $125,000, you can only get the qualified charitable distribution. You would still have to report, in other words, $25,000 of taxable income.
But they are not correct then. So if their RMD is only 65, they could still give 80,000 as a qualified charitable distribution, right? Even though it's more than their RMD. Okay.
Yep. Yep.
So another question then is, what happens to the land if you donate to Charles Schwab? Do they sell it?
Yes, they do.
Okay.
Yep, because they are not going to, that is what the fund does. Remember, this is a mutual fund, a mutual fund company that is a charitable organization, but they invest the cash, then they would sell the land, and with the fair market value that they get, then let's say the property is worth $100,000, they sell it, they then have $100,000 that they invest into the portfolio so that it can be growing. So if you make a $100,000 donation of land into your giving account, you then have $100,000 in your giving account. If you choose not to make any grant requests, to make gifts from it for 3 years, that $100,000 is invested for you and can be growing. That's another advantage to a donor advised fund. It can actually make your gift larger because it's being invested. Now, also, these donor advised funds, for very large donations, I believe it's either 200, I think it's 250,000. So for high net worth individuals, you know, if they have a $500,000 giving account, it can actually be set up where their investment management firm could invest the giving account for them. And I believe it's $5,000 to open up a donor advised fund.
Right, that was one of the questions, is there well, actually, this is a different question. Is there a minimum required distribution from a donor advised fund?
No.
And is there a requirement for distributions each year after reaching the 5-year period?
No, you just have to have made a grant request after 5 years of opening up the donor advised fund.
But there isn't a requirement each year then to do a distribution? Mm-hmm.
No.
Okay.
No. And the other thing to be sure you understand too, when you make a charitable contribution to a donor advised fund, the reason it's out of your estate is it's irrevocable. So you have gifted it. You don't get to have any control over it. And land is a great example, because let's say you want to make a gift of land, and you don't intend to, you know, you want to put it in your donor advised fund, but you don't intend to put in the request to have a gift made to your organization like Groundswell, that land is no longer yours. You know, that you can't continue to use the land. It is just like if you sold it to Schwab Charitable, because they are going to take that donation and turn around and sell it. Okay. So they do not hold on to any kind of asset that is contributed to a donor advised fund.
Going back to the IRAs, here's another question. If we are above 60 and a half, but are under 71 and do not need the income from the IRA in our retirement, is there any reason in this year that my husband and I wouldn't take the maximum from our IRA, our combined AGI, and transfer to our donor advised fund?
So if you're under age 70 and a half, if you were not already age 70 and a half in 2020 or 2019 and had to start taking required minimum distributions, you don't have any required minimum distribution amount. So what you could do is to take advantage of that full 100% of your AGI deduction, you could make that gift up to $100,000. So if you both have $1 million IRAs, you are not age 72 yet, or were not already having to take required minimum distributions in 2019, you could take a distribution from your IRA. It would be a cash distribution, and then you would write a check to the recipient organization.
And in this case, they're actually talking about transferring it to their donor advised fund.
Yes, actually, then the $100,000, I'll check on that if they want to send me an email. I just want to make sure I'm not going to give out wrong information. But you can, the $100,000 qualified charitable distribution limit does not apply to gifts to donor advised funds. You just can't say, if this couple both had to take $60,000 required minimum distributions, if they would have had to start taking those in 2020 because they were now age 72, They wouldn't have to take those if they wanted to, or let's say it's 2021. They have $60,000 each required minimum distributions. Rather than having to take those and pay taxes on it, they could each make a qualified charitable distribution, but you cannot, the IRS does not allow you to make that contribution to a donor advised fund and have it count as your RMD.
Right. But they're saying that they are under 71.
Mm-hmm. So you could give $200,000 to a donor advised fund. That, you know, you could do 250,000, and you don't have that limit.
Okay. But right, it sounds like maybe they should send you an email just so that you can confirm that that would be okay, that there
Right.
that there is no reason why they couldn't
Right.
do that.
Right. And
Okay.
any time as far as what are the tax advantages going to be for you, if you work with a tax advisor, and one of the things that we do have at SVA is we have certified public accountants. In fact, SVA Financial is part of the SVA companies, SVA Certified Public Accountants and SVA Consulting. So we have the tax experts in-house. If you work with a tax advisor, certainly make your charitable giving plans part of your tax planning strategy.
Okay. Well, we did go over time a little bit. Thank you everyone for sticking with us. Were there any other last questions? It doesn't appear to be, so I'm going to again encourage anyone to contact Jeanne directly, or feel free to send it to me and I can connect you with Jeanne as well if you have any further questions about this. We hope it was helpful. I know that, you know, with the CARES Act, there are all of these new rules that people, I think, want to get answers to, and that's what we're here for today. So thanks again for joining us. I will share this recording, the link to it, hopefully by tomorrow. And again, feel free to contact either myself or Jeanne directly.
Thank you, everyone. It was a pleasure talking with you today.
Thank you. Thanks, Jeanne.
Mm-hmm.